Hello everyone. Welcome to Sam's Summaries. This episode is a deep dive into Sam Fury's summary of Swing Trading using the 4-Hour Chart Book 3 by Heiken Ashi Trader. It has been created with the help of AI. It is titled, Where Do I Put My Stop? You can read the original post at samfury.com.
Welcome back, everybody. Today we're going to be doing a deep dive into a book all about mastering one of the trickiest parts of swing trading, managing risk. Now, you might think a book on stop loss is going to be super dry, but this one really surprised me. It goes way beyond just the technical stuff and gets into the psychology of trading, which I think is so important.
Absolutely. Yeah, that psychological aspect is often what separates those consistently profitable traders from those who struggle.
Right. I mean, we've all been there. That feeling of panic when a trade goes against you, or that temptation to hold on to a winner for just a little bit longer, even when your gut's telling you to get out.
Yeah, the source really hammers home this point.
Yeah.
That swing trading is a business. And just like any business owner, you need to minimize costs and maximize profits. But in trading, your costs are your losses.
Okay, so that makes sense in theory, but accepting losses is definitely easier said than done. I'm curious how the source actually addresses this.
Well, it takes a pretty counterintuitive approach, actually. It argues that accepting losses is crucial for long-term profitability. Instead of viewing a loss as a failure, you need to see it as the cost of doing business.
So it's almost like paying for valuable information. You learn from the loss and adjust your strategy accordingly.
Exactly. Each loss is a data point that helps you refine your approach and make better decisions in the future. The source emphasizes that the key is to cut your losses short before they spiral out of control.
That brings us to the heart of the book, stop-loss strategies. It talks about different types of stop-loss orders, right?
Yes. It focuses on two main types, the simple stop-loss and the stop-loss limit order. Think of them as different tools for managing risk. Each has its strengths and weaknesses, depending on your individual trading style and the market conditions.
Okay, I'm intrigued. Break it down for me. When would you use one versus the other?
Let's say you're worried about a sudden market drop and you want to get out of a position quickly. A simple stop loss is your go-to. It executes the moment the price hits your stop level, no matter what. It's like ripping off a Band-Aid fast and decisive.
But what if the market is super volatile and gaps down overnight? Couldn't you end up selling much lower than your stop price?
That's the risk with a simple stop loss. In a fast-moving market, you might not get the price you were hoping for.
So that's where the stop-loss limit order comes in?
Precisely. A stop-loss limit order gives you more control. It says, I'm only willing to sell at this specific price or better, but there's a catch. If the price gaps down and never hits your limit, your order won't be filled.
So it's a trade-off. More control, but also the risk of your order not being executed at all.
Exactly. The source gives a great example to illustrate this point. Imagine you're holding a stock trading at $52, and you set a stop-loss limit order at $50. Then, some unexpected bad news hits the market overnight. The stock opens the next day at $48, completely bypassing your stop-loss limit.
Ouch. That scenario would definitely make me rethink using a stop-loss limit in a volatile market.
The key takeaway is that choosing the right order type depends on your individual risk tolerance and the specific situation. There's no one-size-fits-all approach.
Right. Now, aside from the technical details, this source seems to really emphasize the psychological side of trading, which I think is super important.
Absolutely. The author has a great line, a successful trader is never the victim. It's all about taking ownership of your decisions and not letting emotions dictate your actions.
I love that. It's about realizing that you have the power to control your own destiny in the market.
Exactly. The source really digs into the importance of having a clear trading strategy and sticking to it. Even when things get tough, you need to be disciplined and not let fear or greed cloud your judgment.
That's where the concept of free trades comes in, right? The source talks about that as a way to manage risk and boost trader confidence.
Yes. It's such a simple yet powerful idea. Essentially, once a trade moves in your favor, you move your stop loss up to your entry price. This guarantees that you won't lose any money on that trade.
So even if the trade reverses, you're out at breaking in. It's like a safety net that lets you breathe a little easier and potentially ride the wave of a winning trade.
And psychologically, it's a game changer. It eliminates that fear of loss that can paralyze so many traders.
This is reminding me of another important point the source makes, not setting stop losses too tight.
Oh, absolutely. It talks about giving winning positions. Room to breathe, so to speak.
Because if your stop loss is too tight, even a small fluctuation could trigger it. and prematurely cut off a potentially profitable trade.
Exactly. The source advocates for using trailing stops strategically to ride the upward momentum
Yeah.
while still protecting your profits.
Okay, so we've covered a lot of ground here, but I'm starting to see how all these pieces fit together. It's not just about entering and exiting trades. It's about having a comprehensive risk management plan and the right mindset to navigate the market's ups and downs.
And speaking of navigating, the source brings up a fascinating point about time management, even in winning trades.
Wait, time management in winning trades? I'm not sure I follow. What's the connection?
Well, the author argues that a winning trade can still cost you money if it ties up capital. That could be used for potentially more profitable opportunities.
So even if a trade is in the green, you're saying it's not necessarily a good thing to just sit on it.
Right. It's all about opportunity cost. The source asks you to think of it like this. What if you had money just sitting in a low-interest savings account? You might be technically gaining a little bit, but you're missing out on potentially much higher returns elsewhere.
That's a great analogy. So how do we actually apply that to our swing trading? Are there any specific tips from the source?
The source suggests regularly evaluating your open positions, even the ones that are currently winning. Ask yourself, is this still the best use of my capital right now?
So we should constantly be scanning for better opportunities, even if we're already in a trade.
Exactly. The market is constantly evolving, and new opportunities are always emerging. The source emphasizes that flexibility and adaptability are key traits of successful swing traders.
This is making me think about my own trading habits. I definitely tend to hold on to winners for too long, even when I have a nagging feeling that I should be taking profits.
It's a common trap, especially when emotions get involved. The source is all about removing emotion from the equation as much as possible.
Well, speaking of removing emotion, let's talk about one of the most emotionally charged aspects of trading, leverage. The source takes a pretty hard-line stance on this, doesn't it?
It does. The author straight up says to avoid leverage entirely, which I know is a controversial viewpoint.
I have to admit that surprised me too. I mean, a lot of swing trading strategies rely on at least some leverage to amplify gains, right?
That's true. But the source argues that leverage is a double-edged sword. Sure, it can magnify your profits, but it also dramatically increases your risk.
It's like that old saying, the higher you climb, the harder you fall.
Exactly. And the author is all about minimizing the potential for those catastrophic falls. Remember, this book is focused on risk management above all else.
So instead of chasing big wins with leverage, the source advocates for a more slow and steady approach to capital growth.
Right. It's about consistency and protecting your downside. The author stresses that preserving capital is the single most important factor in long-term trading success.
That makes a lot of sense, but it also requires a certain level of discipline, right? I mean, it's tempting to try and get rich quick, especially when you see other traders making huge gains with leverage.
Absolutely. Discipline and patience are essential qualities for any successful swing trader. The source reminds us that trading is a marathon, not a sprint.
Okay, so no leverage. What about position sizing? Does the source give any specific advice on that?
It definitely does. The source has a hard and fast rule. Never risk more than 1% of your total trading capital on a single trade.
Wow, that's pretty conservative. But I guess it makes sense, given the emphasis on risk management.
Exactly. By sticking to that 1% rule, even a string of losing trades won't cripple your account.
That's a good point. It gives you the breathing room to recover and stay in the game for the long haul.
And it forces you to be more selective with your trades. You can't just throw money at every opportunity that comes along.
You have to choose your battles carefully and only enter trades that have a high probability of success.
Precisely. The source emphasizes quality over quantity when it comes to swing trading.
Speaking of quality, I remember another piece of advice that really struck me. Avoiding the multitasking trap. The source cautioned against having too many open trades at once.
I remember that too. And it ties in perfectly with what we were just talking about. Focus and discipline.
Right, it's like trying to juggle too many balls at once. Eventually, you're going to drop something.
Exactly. Managing multiple trades can spread your attention too thin and increase your cognitive load.
And that can lead to sloppy decision-making and unnecessary mistakes.
The source argues that it's better to have a handful of high-conviction trades that you can manage effectively than a dozen trades that are dividing your attention and stressing you out.
That makes a lot of sense. It's about being present and focused with each trade, not just scattering your energy everywhere.
And the source connects this back to the idea of treating trading like a business. If you were running a company, would you try to take on 1 million projects at once, or would you focus on a few key initiative that have the potential for the highest return?
I definitely focus on the high-impact products. It's about working smarter, not harder.
Exactly. And the same principle applies to swing trading. By being selective with our trades and managing them with focus and discipline, we increase our chances of success.
Okay, so we've talked about risk management, the importance of a winning mindset, stop-loss strategies, leverage, position sizing, and even the dangers of multitasking. Is there anything else that really stands out to you from the source?
There's one more key takeaway that I think is worth highlighting, and it all comes back to the central theme of the book. It all circles back to treating swing trading like a business.
Right, we've touched on that throughout this episode, but how does the source bring it all together?
Well, it uses this powerful metaphor, the idea of trading being like owning a vending machine business.
Okay, I'm listening. Tell me more.
Imagine you own a bunch of vending machines. Your goal is to make a profit, right? But to do that, you need to carefully manage your inventory, choose the right locations for your machines, and keep them stocked with products that people actually want.
And of course, you need to make sure the machines are working properly and not constantly breaking down.
Exactly. And just like a vending machine business owner, a successful swing trader needs to have a system in place to manage risk, make informed decisions, and maximize their returns.
So the stop-loss strategies are like choosing the right locations for your vending machines. The 1% risk rule is like making sure you don't overspend on inventory. And having a clear trading strategy is like knowing what products to stock to attract customers.
That's a great way to put it. And just like a vending machine business, swing trading takes time, effort, and patience to build up a consistent profit stream.
There's no get-rich-quick scheme. It's about building a solid foundation and making smart decisions over the long haul.
Precisely. And the source encourages you to embrace that long-term perspective. It's not about winning every single trade. It's about developing a sustainable approach that generates consistent profits over time.
This has been such an eye-opening deep dive. It's really made me rethink my whole approach to swing trading.
I'm glad to hear that. I think the real beauty of this source is that it provides a practical framework that you can apply to your own training journey, regardless of your experience level.
Right. It's not just theory. It's filled with actionable advice and real-world examples that you can actually use to improve your trading.
And it doesn't shy away from the tough questions. Remember that controversial stance on avoiding leverage entirely. That's something I'd love to get your take on.
Yeah, that definitely sparked a lot of thought for me. While I understand the author's emphasis on risk management, I'm still grappling with the idea of completely eliminating leverage from my swing trading strategy.
I think it's a great point to ponder. Could there be a middle ground? Perhaps responsible leverage use, tailored to your specific risk tolerance and trading style.
That's definitely something I'll be exploring further. This deep dive has given me a lot to think about and apply to my own trading.
And hopefully, it's inspired you to keep learning and refining your approach.
Absolutely. Well, on that note, I think it's time to wrap up this deep dive into swing trading wisdom. Thanks for joining us on this journey, and we hope you've gained some valuable insights along the way.
Remember, the key is to take what you've learned and apply it to your own unique trading situation. There's no one-size-fits-all approach.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.